It's happening. The used RV market just collapsed. 4 million units got dumped. Values down 30%, and buyers think they're getting deals. But behind every discount is someone losing everything.
The RV industry says California's zero-emission rules are driving out business. Fox's Max Gordon is at an RV dealership in Fountain Valley, California, with more.
Financing's freezing up. Dealers are drowning in inventory, and banks want out. This isn't a sale, it's a sell-off. And if you own a rig, what happens next could hit your wallet hard. And the next drop, it's coming faster than anyone expects. Right now, the used RV market is unraveling faster than anyone imagined. More than 4 million rigs just hit resale listings in the last quarter of 2025. The counter is still climbing. On screen, you can see auction receipts showing the same 2002 model going from $130,000 in summer to $91,000 by October. Dealers are not running clearance sales. They are liquidating. Every markdown is a confession that demand has collapsed and financing has dried up. What you are watching is not rumor or prediction. It is happening in real time. Across every major resale platform from Texas to Michigan, rows of rigs once promoted as freedom on wheels now sit under price banners no one can believe. Buyers smell opportunity, sellers smell fear, and banks want out. By the end of this breakdown, you will know exactly which states are already trading below book value and which ones are about to follow. But to see where this started, you need to look at what flooded the feeds first. The listing explosion. It began quietly, 1 or 2 listings that looked like bargains. Then overnight, resale platforms went from a steady trickle to an outright surge. Thousands of fifth wheels, travel trailers, and luxury Class A coaches all appeared within days, tagged with VINs stretching back to the pandemic boom years. Owners who once bragged about their rigs are now racing to unload them before the winter storage bills hit. Scroll any marketplace and you will see the pattern. Barely used, stored indoors, life change forces sale. Translation: loan payments are choking them. This isn't seasonal turnover. It is an oversupply shock colliding with flat demand. The pandemic produced too many units, and today's buyers cannot absorb the overflow. Each new listing pushes the price floor lower, dragging every owner's equity with it. When one sells $20,000 below its remaining loan, the next must follow or sit unsold for months. And while the listings pile up online, the real squeeze is happening in the monthly statements. If you've already seen prices crash in your area, hit like and drop your state. Let's map this collapse together. Rate shock and household fallout. 2 years ago, the average RV loan carried interest near 3%. By autumn of 2025, that figure has jumped beyond 8%. Monthly payments on even modest rigs have doubled. For households already juggling higher fuel and insurance costs, that rise is catastrophic. Negative equity has become the silent epidemic of the RV world, owing more than the rig is worth and watching values fall faster than principal can be repaid. Every extra % of interest translates to hundreds of dollars each month, lost to finance charges instead of freedom. Families who once took weekend trips are now canceling insurance or skipping maintenance to stay afloat. The bank doesn't care that you're current. It knows the asset backing the loan is depreciating faster than it can repossess. Even responsible owners are realizing the truth. If you bought between 2020 and 2023, the market has already reset the value of your rig without asking permission. And when those payments snap, repossession trucks start showing up before sunrise. Repossessions at dawn, factory echo. Across the country, quiet storage yards are turning into graveyards of broken budgets. Tow operators describe a new routine, collecting Class Cs before daylight so neighbors don't see. Rows of rigs sit behind chain link fences, their windows dark, their titles frozen in lender custody. Every unit on those lots is another data point in the same collapse. Too many loans, too few buyers, and zero safety net. Dealers whisper about inventory recovery programs, a polite term for repossession auctions that will soon flood the pipeline again. Behind each recovery is a family that ran out of room to refinance. Lenders issue form letters and legal disclaimers, pretending these are isolated defaults. They are not. They are the overflow of an industry built on borrowed optimism. And those silent rows of repossessed rigs, they are not the end of the story. They are the start of the next crisis forming in the factories themselves, where production lines now hum to build what no one can afford. Because the factories that fueled the boom are about to face their own reckoning. Overbuild 2020 to 2025. Between 2020 and 2023, the R-vee industry built like there was no tomorrow. The Recreational Vehicle Industry Association logged more than 1 million units rolling off production lines each year. Factories ran double shifts, credit was cheap, and every marketing campaign sold the idea that road life was recession-proof. Buyers rushed in with stimulus checks and borrowed confidence. Manufacturers mistook a temporary surge for a permanent future. What they really created was an inventory time bomb. Now the math is catching up. When demand corrected, every excess rig produced during those 4 golden years began hunting for the same limited pool of buyers. Dealers went from wait lists to backlogs almost overnight. Warehouses filled faster than transporters could move units. The result is brutal economics. Every R-vee built during that boom now chases half as many customers. Supply didn't just exceed demand, it obliterated it. And while the headlines celebrated record shipments, the factory towns felt the first signs of the slowdown. Factory slowdowns and town fallout. Drive through Elkhart, Indiana, or Forest City, Iowa, and you can feel the air has changed. Parking lots that once overflowed with shift workers now sit half-empty by midweek. Inside the plants, overtime vanished first, then entire shifts disappeared. Managers call it production adjustment, but locals know what that means. Less work, fewer paychecks, and smaller orders for the shops that depend on the factories. For communities built around the R-vee trade, every slowdown ripples outward. Cafes near the plant gates close earlier. Tool suppliers run discounts they can't afford. Families that once assembled motorhomes are suddenly trying to sell theirs to cover bills. It's a full-circle collapse, production and consumption dying together. When the assembly lines pause, the used market suffers twice. Fewer buyers with steady income, and more former workers selling what they already own. But even as towns brace for layoffs, dealers are fighting a quieter, costlier battle inside their own books. Wholesale pipeline and dealer triage. Behind every showroom price tag sits a financial leash called floor plan financing. Dealers borrow money to hold inventory, paying interest until each unit sells. When sales slow, those interest costs pile up like unpaid rent. For some dealers, the floor plan bill now runs higher than payroll. Data from wholesale auctions such as Manheim show exactly what desperation looks like. Rigs dropping 30% below book just to stop the bleeding. This is triage, not strategy. Units are being dumped wholesale to reduce interest exposure. You can see the proof in the spread between wholesale and retail prices, widening month after month. Dealers aren't cutting prices because they want to move inventory. They have to. Every extra day a rig sits on the lot costs them more than it's worth in margin. That's why listings that once lingered for weeks now change price tags every morning. And when retail markdowns become the only survival tool left, price gravity starts pulling the entire market down. Price gravity on lots. Walk any dealership lot this month, and the numbers speak louder than sales pitches. Price tags once showing $120,000 are slashed to $95,000 in red ink. Dealers whisper about market alignment, but everyone knows what it means. The market is collapsing under its own weight. Auction data confirms that average used values have fallen more than 30% since spring. Every markdown resets the floor for the next sale, forcing even cautious dealers to follow suit or be buried under unsold rigs. For viewers tracking the downturn, this is the first real signal of bottom formation. The flood of inventory is finally meeting reality on paper. If you think the crash has already arrived, hit the down arrow. If you believe prices rebound by December, hit the up arrow. That vote tells the story faster than any analyst can, because as this wave of markdown settles, dealers will start looking for new ways to claw back those losses, starting with you. Dealer survival games. When retail prices fall faster than they can be printed, dealers find new ways to rebuild lost profit. On paper, hidden inside every sales contract are line items that look small but add up fast. Extended warranties, gap coverage, tire protection, documentation fees. Each one padded to restore margin without raising the sticker price. It is the quiet math of survival. The salesperson congratulates you for saving $10,000 off retail, but the back office claws most of it back in fees and financing. proof is right there in the paperwork. Contracts reviewed from multiple states show identical add-ons repeating across brands, often totaling more than 8% of the purchase price. Dealers call it customer protection. Accountants call it profit recovery. Either way, the buyer loses. Even trade-ins are rigged through low appraisals to make room for inflated savings on the next rig. On the surface, it looks like generosity. Underneath, it is arithmetic designed to shift their losses onto your balance sheet. But the pressure doesn't stop at the dealership lot. It follows owners all the way to the places they park. Campground squeeze. The open road used to be a refuge. Today, it feels more like a subscription plan with no off switch. Campground fees that once averaged $30 a night now hover near $60, and the price of quiet is climbing faster than fuel. Corporate park chains have bought out hundreds of family-owned sites across the country, replacing friendly staff with dynamic pricing systems that track demand. Like airlines, weekends and holidays cost double. Long-term tenants face new infrastructure surcharges. For full-timers hoping to ride out the market slump, these increases erase any savings from living mobile. Many parks now require background checks, deposits, and proof of insurance, costs that never existed 5 years ago. Maintenance has not improved. Hookups fail, amenities shrink, and yet the bills keep growing. What used to be freedom now feels like paying rent on wheels. Owners who thought they could downsize their expenses discover that even parking peace comes with a premium. And while park fees tighten the lifestyle, government policy is quietly tightening the wallet. Policy whiplash. Every market correction brings new regulation, but the latest round has hit ordinary owners the hardest. Tariffs on imported parts have doubled the cost of repairs for most late-model rigs, since nearly half of all components, from fixtures to electronics, come from overseas. A replacement slide motor that cost $400 last year now lists near $700. Insurance companies adjust premiums accordingly, citing higher replacement values. When large fleet operators file too many claims, individual owners pay for it through group rate hikes. Local governments are adding their own strain. In several states, counties are reclassifying private R-vee storage yards as commercial property, triggering new tax rates. Even homeowners who park on their land face zoning fines. Policy meant to stabilize the industry is instead raising the cost of ownership for everyone still hanging on. And for many families, that was the last straw. When the rules and bills both change mid-year, there's only one move left: to sell and cut losses before the next adjustment arrives. Which brings us to the human side of the collapse. The quiet exits that feed the illusion of cheap deals. Subscribe now, because the next price drop's already forming, and you'll want proof before dealers spin the story again. Exit stories. Buyer mirage setup. The listings that look like once-in-a-lifetime bargains all have stories behind them. And most aren't happy ones. Across the country, families who bought during the boom are surrendering rigs to cover medical bills, job loss, or simple exhaustion. A couple in Arizona sold their Class C after the transmission failed twice. The repair quote was 2 months of wages. In Michigan, another family listed their trailer just to pay for surgery. Their post read, "Too many memories to count." These sellers aren't flippers. They're escaping debt. Every discounted rig adds to the cycle, tempting the next buyer into hidden trouble. For cautious shoppers, each markdown hides a story. Those cheap listings aren't deals. They're distress signals disguised as opportunity. And in the next part, we'll expose how those bargains can turn into traps and how to spot the real survivors. Buyer's mirage. The listings look like miracles. Half-price Class A rigs, luxury fifth wheels marked down 40%, and travel trailers that seem almost free. But when a deal looks too good, it usually leaks, literally. Many of these rigs sat through floods, storage neglect, or rushed repairs before being flipped online. Under the fresh wax and new photos are water stains, soft floors, and electrical corrosion that tell the truth. Dealers and private sellers both count on desperation to override caution. Before signing anything, check the tire date codes, slide seals, and roof seams. Ask for maintenance logs, not promises. If a seller hesitates, walk away. One inspection flashlight can save thousands in regret later. You are not just buying a rig. You are buying the history that comes with it. Every flooded or neglected unit that sells keeps the illusion of a bargain alive. And even if you find a clean rig, the next challenge hits the bank, where credit itself is becoming the new gatekeeper. Credit chains and refi walls. For years, banks begged borrowers to finance R-vees with minimal paperwork. Now, they are quietly shutting those doors. Internal policy memos show that several national lenders have raised their minimum loan thresholds to $50,000 and restricted approvals on any rig older than 10 years. Credit unions remain more flexible, but even they are demanding higher down payments. This shift traps thousands of owners and buyers in what experts call refi walls. If you still owe more than the R-vee's market value, refinancing is nearly impossible. Families are stuck paying on depreciated assets while interest costs climb. For new buyers, the best move is to shop small, local credit unions, not big banks, and cash where possible. Dealers will push long-term financing because it hides risk. But every extra year adds invisible cost. When lenders stop trusting the product, it's a warning. Still, every correction leaves a moment when value and timing finally meet. And that moment is forming right now. Autumn wave. All signs point to a clear timing window. Data from October through December shows that states in the Midwest and Southeast are already listing rigs 20% under book value, the lowest in 5 years. These are the green zones, where patient buyers can finally negotiate from strength. Western states remain yellow, still adjusting, while high-cost coastal regions stay red, overpriced and risky until the new year. The sweet spot lies in weeks 43 through 45 of the calendar, late October through mid-November, when storage fees collide with desperation. If you plan to buy, use information as currency. Compare book value to real sale receipts, verify mileage, and inspect carefully. Wait a few weeks. Timing beats hype. Vote if the crash is here. If you expect a rebound, your call reveals truth. Because beyond prices and timing, there's one more story. The owners fighting to rebuild control from the wreckage. Owners stand and next 30 days. Not everyone is walking away. Across the country, small groups of owners are quietly banding together, sharing storage lots, trading parts, and teaching each other repairs once billed at dealer rates. These cooperatives are cutting monthly costs in half and keeping rigs alive through skill instead of finance. It is the start of a grassroots recovery that puts independence back into the lifestyle. Proof is appearing online. Neighborhood repair meetups, co-op insurance pools, and barter boards where experience replaces cash. For the cautious road warrior, this is the way forward. Knowledge beats panic. Wait 3 weeks before making any big decision. The next price drop is already priced in. Use that time to inspect, budget, and plan instead of react. The crash exposed greed, but it also revealed resilience. They built the bubble, but you decide how to rebuild the road. Stay sharp, stay patient, and don't let anyone rush you. The real freedom isn't the rig. It's knowing how not to overpay for it, because in 30 days, the numbers will tell who listened and who got left holding the keys. The R-vee market's rewriting its own rulebook. 4 million rigs dumped, prices spinning, and lessons written in debt. But this story isn't ending, it's resetting. The smart ones aren't panicking, they're preparing. Prices, repos, and dealer panic are only getting worse. Stay ahead of it. Subscribe now, hit the bell, and don't get left holding the keys when the next drop hits.